Stock futures moving to the downside here this morning to kick off the final trading day of September. We're also going to be wrapping up the third quarter. Wall Street is poised to end the month on a positive note. The stocks are actually headed for their best September in more than a decade. The big test for the markets and what we could see allocation-wise will be the jobs print on Friday. And here's why this is so important. Goldman Sachs chief strategist David Kostin saying that the strong jobs print could actually prompt some investors to take on more risk. And we've been talking about what is going to be leading this market higher. We've been putting this question to so many strategists here, Maddie, over the last week and a half, ever since we did get that 50 basis point print. And it seems like overwhelmingly there has been this sentiment, at least on Wall Street, that mid caps are poised to outperform in this environment. Yeah. But what really stuck out to me from Kostin was that we have seen investors be a little bit risk adverse at this point. They're not exactly piling into small caps, a trade that did get a lot of attention ahead of the rate cut. And I think that if we do see a very strong jobs print on Friday, that of course is going to reaffirm the soft landing narrative. It's going to give investors a little bit more confidence in the market. And then as a result, we could see some of these investors, and maybe a bit of a reversal from the chart that we're looking at here, but investors then piling into those smaller stocks that maybe don't have the strongest balance sheets, but that is really a sign that investors are willing to take more risk.
Yeah, it's fascinating given the conversations that I know we've both had with sources, this question about whether we are going to see a continuation of the great rotation or the everything rally where it's just good news across the board. I want to pull up another chart from Torsten Slok because another test for markets. We've got that new earnings cycle coming on board here in just a couple of weeks. And it's interesting in this chart, Torsten noting that 42% of companies in the Russell 2000 have negative earnings. For the mid caps, that number is 14%. In the S&P 500, only 6% of companies having negative earnings. So you can see in that chart why some investors might say, hey, let's actually just stick with what's been going well, not only the S&P 500, but also the S&P 7, those magnificent 7 names. I think a big question we're going to have is whether or not the rate cuts to come are going to be enough to continue this rotation into some of these smaller names.
Yeah, exactly. And then if we do see some of that outperformance, just where it's going to come from, because that really is the next big test for the markets as you look beyond Fed policy, as you look beyond maybe what some of these econ data prints are going to cause here over the next several weeks. It's really going to be the earnings picture and what we're seeing there, what we're getting from guidance that is really going to help shape the next leg, maybe potentially higher, of the broader market.